Hello and welcome to another technical analysis tutorial. In this tutorial we want to talk about the Wyckoff accumulation phase, the Wyckoff pattern you can find time and time again in charts, and there are various sub-patterns and more detail. But on this channel, to start with, we want to start with the simple stuff and we want to keep it quite simple, and I'm going to show you how you can use, especially in this video, the accumulation phase for trading, for entering trades, and to understand charts better. In another video we will talk about distribution phase and also the other Wyckoff patterns and phases. So with this Wyckoff pattern that consists here on this simple chart of an accumulation and a distribution phase, you can find these, as I said, again and again on charts. And an accumulation phase begins after a downtrend. It can typically last 3 to 6 weeks, but it also depends on the market cap, on the market. I found in cryptocurrencies it can be shorter, for example. In stocks it can be a bit longer, depending on the market cap. And after the accumulation phase, where you have a little bit back and forth here and a very characteristic breakout to the downside of that channel, which fails, and then a move to the upside and typically a retest, and then you move to the upside, and then you have this distribution phase. You have very characteristic sub patterns, and I prepared a chart and we can take a look at an example. I'm going to tell you what is happening. But typically what is happening in the market is after a downtrend that institutional buyers, especially institutional buyers or buyers with a lot of funds, they get into the market when the price hits their critical level. So they get into the market probably at some point here because of the funding and the money available and the budget available. They actually have the power to move the market. So they are careful, they don't push the price up too much, and then they have to buy in stages. So they might buy here, they might buy here, and they might buy here. And they have to be careful not to buy everything at once so that the price shoots up and they, well, miss their buying opportunity or get worse prices. So they want to invest in stages, right? And also to spread the risk, because in the end, you never know if the prices drop further. That is why they invest in stages very carefully, and that is particularly why this accumulation phase emerges, mainly because of large investors, institutional investors. But you as a retail investor can make use of that as well. I've got an example here from the Bitcoin chart, and I said for cryptos, in my opinion, it can be a bit shorter. And this is the 4-hour chart. In my opinion, it works on all time frames, but it works well on the 4-hour chart. Also on the daily chart, it works well, but I found it particularly useful on the 4-hour chart. And this Wyckoff pattern, in my view, started here on the 15th of July and it finished on the 23rd of July. So we only had a week. And what we can see here is that we came from a prolonged downtrend. Yeah, so we came all the way from up here to the downside. We moved into this pattern. So what you characteristically find is that you have a channel forming here and you touch that channel to the downside. You have a very strong downtrend, so very strong red candles, and you can see that here. That's the first strong move where you touch the downside of that channel. Then you have at least a move to the upside, which you have here, perhaps a second one, and you touch the upper side of that channel, at which point you can then start to draw some lines here. Then you have another move to the downside, and this is typically called a spring. Yeah, this is quite an extensive spring. It doesn't need to be that extensive. It can be shorter as well. So it is a break to the downside of that channel. And at some point we will bounce back in. So in this case, it took actually it took only a day to break back in. But it is that spring phase that so many people talk about. It is where that breakout actually fails. It's a fake breakout. And then we move very strongly, very powerfully back to the into this channel. And for the very first time for a long time, you can see a very, very strong uptrend, right? So you see these green candles. You can't see such strong candles throughout this downtrend here. Yes, there is one here, but it's shorter than what we see here. So you have a very, very long green candle and another green candle before. And then there was an attempted breakout, but essentially you move up and up and up, get very close to that upper side of the channel, which we call breakout build-up, or essentially what happens is that the sellers cannot push the price away from that upper resistance level anymore. Then this is the classical breakout phase or preparation of a breakout, where you make lower highs and also higher lows and higher highs. We've been talking about that on this channel before. And then at some point there is a breakout, and then you have the retest, and these are the phases. So in summary, you touch that lower support of that channel, then you move up once more, at least once, then you break to the downside, which is that spring that so many people talk about. Then you have a very strong trend move to the upside, which is slowing down as you approach that resistance line. Then you have a breakout and a retest, and if that retest is successful, that is what you can see here, that retest, and when that is successful, you actually move all the way up. At some point then you will reach a distribution phase, and this is where you as a trader can use this pattern to understand when to enter a trade. So a lot of traders would use it to enter a trade here after a successful retest. You can also enter the trade here at the first breakout, but you can see that this, for example, was a fake breakout. So had you come in here, you would have been thrown out basically. So this is why you also need to wait, in my view, until one candle closes. For example, on the lower time frames, you can use this pattern. Then you can go into the hourly time frame and find good trade entries. Maybe on the hourly, you saw a retest earlier. This retest here failed, obviously. And that is when many traders get thrown out, because they start to trade, they jump in, but they set their stop loss here somewhere at the break-even point above the resistance line or just at the resistance line. So they try not to lose any money, but oftentimes there are these fake breakouts intentionally so that people are thrown out of the market again and other people can jump in earlier, cheaper. So that is why I generally wait for a successful retest and then I get into the market on a lower time frame than, for example, on the hourly one or even the 30-minute, but generally I use the hourly one. And yeah, then you jump in and you can see that that continued as a nice trend to the upside, and at which point then up here at some point we had a reversal again, but quite some nice profits to be made here. And in my view, a classical accumulation phase after a prolonged downtrend. And as I said, for cryptos it can be a bit shorter, it can be longer for some stocks depending on the market cap, typically 3 to 6 weeks, but again, for cryptos it can be shorter. So hopefully that was a useful video. I'll make other videos on the accumulation phase and the larger picture as well, but this is another interesting pattern here that we can use to understand markets, to understand what the market could be doing next, and also to time trades. Okay, so hopefully that was useful. If you liked it, please smash the like button, and if you want to follow me on this technical analysis journey, then please subscribe. Thanks a lot for watching and see you in the next video. Bye bye.